A large part of successful investing comes from mastering our mind and thoughts. Is to train our eyes and mind on what to look for. These are 5 investing mistakes people make. The first mistake that so many people make is not knowing what you own. You see, a lot of people own stocks, but only a few would be able to tell you why they own it. If you're not able to explain why you own it, in a minute or less, it's best not to own it at all. They usually just say it's going up, and that's the only reason why they own it. It doesn't work. This is the single most important principle. Stocks are not lottery tickets. There's a company behind every stock. This was a mistake I made early on, and once I stopped looking at stocks as stocks and started looking at them as companies, it significantly helped me. Invest in what you know. A popular misconception is that you need to own every stock. You don't. They're in your industry. The next mistake people make is being impatient. I remember when I first started, I was in an incredible rush to buy a stock. All I wanted to do was get in stock after another, failing to realize there's a time for everything. You see, you don't just want to get in a stock because you saw it on TV or you heard about it on social media. It's important to block out the noise. Time is on your side. One of the things I learned is don't force positions. That only leads to bad habits and not being disciplined in the future. Here's an example. Take Walmart. Walmart went public in October of 1970. It already had a great track record. You could have waited 10 years and still made 35 times your money. Developing a concise plan for your entries and exits in the stock market will keep you in the game for longer. The third mistake is not looking at the balance sheet. What is the balance sheet? The balance sheet is a snapshot of the company's financial position. Many people may invest in a stock and have no idea what the company financials are like. This is what the balance sheet tells you. Let's take a deeper look into what it looks like. On the left-hand side, it tells you what they own, their assets, while on the right-hand side, it tells you what they owe, its liabilities. Going back to the left side, this may show you how much cash they have on hand or how much equipment they have, for example cars, while on the right side, it can tell you how much cash they owe or how much debt they have to pay off. You see, reading the balance sheet tells you the company's story. Now you may be wondering, alright, I read the balance sheet, what are some questions I can ask? Some important questions to ask is, does it have debt or no debt? Is revenue up or down year over year? Is there room for more growth? You see, it's impossible to go bankrupt if you don't have any debt. The next mistake people make is being over-leveraged in the stock market. It's not always easy to manage your money. Don't use all of your buying power. Why? Because let's say you invest all of your buying power in a single position, and then over the next few days you find that you're down negative 30%. It will be so hard to recover from this. Why? Because you will be forced to play the waiting game. You will feel like there's nothing you can do besides ride it out. And that's the worst feeling in the world when it comes to investing. The way we can avoid this is, let's say for example your buying power is $5,000. At first, use 30 to 40%, then use another 20%. This is the proper rules of pyramiding, and it's extremely important because it will help you stay in the game for longer. The benefits of also not using all of your buying power at once is you minimize risk. Let's say the stock goes down 5%. You're a stronger believer in the stock. Well, you're able to buy in at the lows and you can get some towards the highs. But over time, it'll average itself out. An important quote that I remember till this day that I use is, don't think about what you can make, think about what you might lose. This will help you. Finally, for the last mistake we are going to be talking about in this video is not getting in line with the market. What is the market? The market is not focused on the present, but the future, and it does not care about your feelings. Believe in what you see and not in what you believe. No one can predict the future. Don't let your emotions or bias get in the way. Just get in line. No one expected us to recover so quick. Regardless of what we feel, the market doesn't care. It's a machine. People talk with their mouths and vote with their pocketbooks. Removing bias in thoughts and getting in line with the market, it will help us make better decisions when it comes to investing. So there you guys have it. These are the 5 investing mistakes people make. Thank you all for watching.